You guys ready? Wind-blown Monday. Here we go. It's supposed to get cold though, so enjoy it today. Might be the last day of golf for a while. I don't know. Get out and see. Hopefully I get out this afternoon and get wind-blown, but oh well. A few things. One, let's see, what were we on? Sales forecast and additional inputs. I didn't get a ton of submissions for that, and just about everybody I gave some feedback to. There's some things that need to be corrected. Now, I don't think in any case any of those were difficult things, okay? But let's make sure we get those done today and get those turned in. I think I even go back the one before that, which was what, payroll and operating expenses. I think there's several, I don't know about in here, but there's several people I gave feedback to, and I haven't gotten anything resubmitted to those particular folders, okay? And, which is a reminder, and maybe my fault for not reminding you guys enough, but each time if I give you feedback in that folder, I need you to resubmit it to that folder. That's just the easiest way by far for me to grade it. If I got to try to look it up in one folder and then go back and apply a grade to something from before, it's extremely difficult. It's not difficult, it's just time consuming, okay, for me. So resubmit it, to that same folder if you got some feedback and not a grade. So please, everybody, check your grades in all of those folders for Project 1 in particular, but check your other grades too. If you submitted something, make sure you got a grade. If you didn't get a grade for it, check the feedback, okay? Then if there's something in the feedback, see me if you need to, or get it fixed and then resubmit to that same folder until we get you a grade there, right? Okay. So I want everybody. We're just about halfway through the semester. I guarantee you the problems are going to start getting a little more difficult too. Okay, and Excel is really going to come into play now because a lot of this stuff you could maybe do it by hand. Yeah, you could some of it, but some of it gets to be pretty difficult. And not just by hand, I mean even using a calculator and even using a business analyst, which I have a business analyst and I love it to death. I use the heck out of it, but I've gotten so I use Excel probably more even than using a business analyst, and most of you guys don't have that. I might bring it someday and just show it to you for the heck of it, because I don't have to bring it. I've got an emulator that would put it up here on the screen and you guys could kind of see how that works. They use them down at the bank, I'm sure, still. So either business analysts or HPs that are calculators. You got one? Better get one. Anybody, if you're going to get into finance and whatnot, you might. Texas Instrument makes one that's called a business analyst. Like I said, I'll try to bring it and show you. You can do it's so quick and easy to do payments and that kind of stuff. If you want to calculate payments, you got the HP one, yeah. Somebody comes in and says, I want to buy a car, for 25 grand. What's my payment going to be? You got to be able to figure that out pretty quickly, and you get one of these business analyst types of calculators, and you can do it that way. So when you get into it, you'll find that the commands that are on the calculator are going to be the same as the ones we're looking at up here when we do it on Excel. Okay, I shouldn't say the commands. There's just different entry things that you put in, 3 or 4 of them, depending on the problem and the complexity of it, and they're the same. They're called interest, they're called payments, they're called term or number of periods, future value, and present value. Okay, you get those 5 basic things, and you can do an awful lot with those. And they're the same whether you're in Excel or whether you're doing it on a calculator. So get used to those because we're going to be doing a lot of those. Guys, we lost a little money today, doggone it. Market was all over the place today. Harley, who's got Harley? Who picked Harley? No, not here. That wasn't you. Is that Brian? Yeah, Harley had a tough go. Down 3% today. I just kind of overheard him talking a little bit, saying that the new motorcycle that they came out with isn't going over real well. Millennials aren't buying motorcycles. That's kind of the bad thing. They just don't seem to be investing in them or buying them like folks my age did. If you see people riding motorcycles, there are a lot of gray beards and whatnot, kind of like me. Except that's why I keep mine shaved, because it would be gray otherwise. So yeah, that's okay. We're going to get into some stuff, next week after next, we'll be starting on Project 2. So we got to get Project 1 wrapped up. That's why I was kind of chewing your guys' butt a little bit on that, so we can get those in there and get that done so we can move on to Project 2. I bring that up, and I wanted to show this. I'm less concerned here about the headline. It's kind of a good article. But when we talk about stock buybacks, because you guys might find this with the company that you chose, okay? The company you chose may be buying back a lot of its stock, okay? And I'll give you a local example here in a bit, but what's it mean when a company buys back its stock? Well, a company can go into the marketplace just like you or I. You know, I'm going to oversimplify this, but they could call up their stockbroker and say, hey, I want to place an order and buy X number of shares of our stock at X price, and they buy it. My question to you is this: what's that do to their balance sheet? These are the things we got to start thinking through when we're in finance and when we're looking at our Project 2. What's it do to their balance sheet? Okay, if I buy it personally, what's that do to my personal balance sheet? What happens to my cash? Goes down.
In the long term would be better, correct? I mean, your capital.
Well, what happens to my equity account? Remember, I got to keep my balance sheet in balance, right? So if my cash goes down, it means my assets have gone down then, right? That's the left-hand side.
You're buying stock, though. If you've traded your cash for stock.
Yeah.
Should kind of keep it. As far as assets.
It's got to stay balanced. It's got to stay balanced. Let me, I was going to see if I can do that on Excel. I'd rather show.
Just transferring assets, though, correct?
Yeah, no. No, we're making a reduction in our balance sheet. If assets go down, either liabilities or equity has to go down too for it to stay in balance, right? Because assets are on the left-hand side. You got liabilities and then equity on the right-hand side. So if I'm buying back stock, is it liabilities that go down? Yeah. They don't get affected, right? So my equity goes down too. Okay. I'm reducing my equity. So I might be increasing the leverage of the company a little bit, and that can be good, okay? Because leverage, you can oftentimes make a lot more money with leverage. Not a lot more money, I'm sorry, you don't make more money, but as a return on equity, your return on equity goes up in a case like that because you're reducing your equity, right? Keep that in mind. We'll do a lot of ratios and stuff a little bit later too. And if I lower my equity but my income stays the same, buying back stock's probably not going to affect my income at all. Might just marginally because I might be taking cash out of an investment account, buy back some stock, right? It's probably not going to change my income a whole heck of a lot, but my equity went down, so what happens to my return on equity? It goes up. Now, if I'm a shareholder, I either one, sold my stock back, okay, in which case I got cashed out, or two, all of a sudden the company that I own stock in now has a higher return on equity, okay? And that should, over time, it should increase the stock price then, right? You got fewer shares outstanding, making the same amount of money, your stock price should go up. Okay? That's the theory, okay? When I worked at Independence Bank, they had 20,000 shares outstanding. That's what it started with. They've since had a 10-for-1 split, so you'd think they should have about 200,000 shares outstanding. Last annual meeting I went to, it's a little over 100,000 if I'm not mistaken, right? Okay, yeah. I went to the last annual meeting anyhow, and I think they just have a little over 100,000 outstanding. So the bank itself has bought back about half of its outstanding stock. Okay, why do companies do that? And that's kind of what this thing is talking about. Why do Microsoft has bought back billions and billions and billions of dollars of stock over the last, say, decade and a half? Why do they do that? They're generating cash. And that cash just sits there on the books, okay? And what do you do with it? You know, maybe you buy another company. You can do that. Microsoft bought LinkedIn. That's like a rounding error for Microsoft, okay? And so you do those things. You can, but at some point in time, you run out of your expertise, right? You know, should Microsoft buy General Motors? Probably not. Or John Deere? You know, that's really not in their field. Could they buy them? Again, probably a rounding error for both those companies. For even John Deere's a pretty good sized company, but nothing compared to Microsoft, I don't think. So should they buy it? No. Okay, because it's outside their expertise. And so they got all this cash, and they're still generating all kinds of cash. I mean, it's coming in every quarter, billions of dollars, and you're sitting on a pile of cash. What do you do with it? Okay? You can pay it out in dividends, and dividends is a good choice as well. That pays it out to your shareholders. Okay, but then every shareholder gets that, and then shareholders have to pay taxes on that, and they don't. I'd rather see my stock go up, right? That's me. I don't really want to get dividends because then I got to pay taxes. Okay, I hate paying taxes. I'm weird about that, but I hate paying taxes. Okay, so somebody else, if Luke sells his stock and I keep mine, my stock should go up. Luke gets money. He's happy, right? He can use it for his college and whatnot. And then I'm happy too because my stock should go up in value, and I don't have to sell it yet because I don't want to sell it yet because I got to pay taxes when I sell it too. I don't like that either. Okay, so that's the main reason they do it. If you look at some companies, look at balance sheets. We can look at Apple at some point in time. Apple's got, I think I've said, over $200 billion in cash on hand. Apple has started to aggressively buy back stock too in the last couple of years. They weren't really doing it before because they were reinvesting a lot of money into the company. But at some point in time when you're generating, I don't know, they generate like $10 or $15 billion in cash every quarter. What do you do with it? And Paul, this article is kind of about politicians complaining that they ought to invest it back in their people and whatnot. But Apple doesn't have any problems hiring people, And people want to go to work for Apple. Why do they need to increase their wages? They got people banging down the door still wanting to go to work for them, right? Okay, so they don't need to do that. They can only invest so much in R&D, so buy back stock. If Luke sells his, he can reinvest it in something else then, maybe a new up-and-comer, like Uber or Airbnb or Peloton, right? They just went public, right? IPOs have been ugly this year, though. Okay, anyhow, so much for that. I wanted to just talk about that a little bit. It's kind of a decent article. I did post it. You can read it. Get out. It's kind of more of a political article than anything, but just mainly to remind me. Next on this, right? Now we're getting to cash flow. I got to jump back though. There's a couple things on this thing that I didn't point out, and I should have on the additional inputs. And most of you didn't put anything in there, and that's fine. So don't feel like you have to go back and change it. But I probably should have discussed it a little bit. Desired minimum cash balance. Folks might want to keep a certain amount in their checking account, whether it's a business or your own personal account, right? You could plug that in there if you wanted to. I don't want to fall below 2,000, maybe. Okay, then you're going to get a line of credit advance if you need it. Okay, if you go below that 2,000. If a transaction would have taken you below that 2,000, you'd get a line of credit advance instead to keep it at 2,000, say. That's fine. You could do that. This one here, additional fixed asset purchases. Oftentimes it filled stuff in here. That's stuff that you bought and you showed on your starting point. Make sure you do not put anything else in these white cells. If something's there, that's fine. Just leave it. But it says that if you thought in your business that you may need to expand in the first year, you'd pick the month, and this is just showing additional capital items or fixed assets that you might buy. Okay, if Aaron's taco truck's going so well that he decides he wants to buy another taco truck, maybe he wants to do that in year 2. He'd put in there he's going to buy a new taco truck and he'll pay $15,000 for it or whatever, right? Okay, so you can put the $15,000 in there. Just shows it as a capital purchase. It'll start depreciating that, add it to your statement and whatnot. It'll do everything else automatically for you. It's kind of nice. So if you thought you might need something like that, you can go back and take a look at it. But don't worry, if you didn't put anything in there, that's fine too. Most new businesses, it'd be hard to project those things, to really know that it might happen. Hopefully the business goes well and it does happen, but then you can address it then. Okay, cash flow. We got to take a look at. This is kind of like that one I was just talking about. If you've got a retail business, coffee shop, something like that, you don't really need to worry about it. The food truck business, it assumes that you're going to keep replacing your inventory on a monthly basis, basically. Okay, it assumes that. But again, if you're growing and you think, no, I might need to, at the end of the first year, maybe I need to bump my inventory value up a little bit. okay, you might want to put $1,000 in there at the end of that year. You come here to December and or 12th month, whatever, and put in $1,000 or $1,500 or whatever the case may be. Okay, there's nothing wrong with that. Do you have to? No. You know, again, it assumes that you're going to kind of keep that constant level of inventory anyhow, and it kind of builds that in. But this is available if you think you might need to increase some inventory. Gives you something to look at. If you put it in here, the computer does the rest of it. Now, we get down to owner's distribution. Everybody's going to have some owner's distribution. Okay? You got to pay yourself. Remember, I said you couldn't pay yourself on the payroll. This is where you pay yourself. Okay? And it's just a cash. Okay? You're going to write yourself a check every month for $500. Remember, at the end of the year, you pay taxes on what the business did, good or bad, overall. It doesn't have anything to do with what you take out of the business. Okay? That's just a cash transaction. Doesn't have anything to do with profit or loss, actually, of the business. Okay? You'll see when you put this in here, it won't show up on the income statement. Okay? Because it doesn't have anything to do with the profit or loss. So, shouldn't. So, what do you pay yourself? Okay, you may take a look at what your cash flow is before you pay yourself, right? And if at the end of the year you had a cash flow of $12,000 to the good, you might not want to pay yourself more than $1,000 a month, right? Okay, because otherwise you're going to start going negative. Again, if you went a little negative that first year, okay, I'll buy that. By the second, third year, you should start going kind of positive. So, okay. So that's probably a good way to look at it. Line of credit repayments. Some of you might, in the first few months or even in the first year, you might build up that line of credit. You might see down here, line of credit balance, where you're getting a balance down here. Okay? That's okay. There's nothing wrong with that. But you got to take a look because you might also start it. Let me back up. It will not pay itself back off. Okay, you have to pay it off. So let's say you build up a line of credit balance down here and you got a $5,000 line of credit balance in month 5 or month 6. And then all of a sudden your cash starts to grow a little bit. Business starts to get a little bit better. Okay. Carl, you might especially have this because you're kind of seasonal. And Luke too, you guys are kind of seasonal. So there might be times of the year when you're definitely going to have, negatives, right? But then you might start building cash. Well, if you start building cash that's, enough, then you just come up here and you say, well, I need to start paying that back. Okay. And we want to, for sure, by year 3, we want you to have that zeroed out. Okay. Probably. Unless it happens that the 12th month of the year is a month you would typically have a negative balance, if that makes sense, or a line of credit balance, which could happen. Okay. And all you got to do is if it says your line of credit balance down here is $2,438 and you've got that much, then you just come up here, in that month, if you've got that much cash, and you just type in $2,438 and then it'll zero out your line of credit for you. Okay, so just kind of take a look at that. If you got a line of credit, you got to stick your hand in the air and I'll come around and we'll make sure that we get her taken care of. Okay, it's the same things for years 2 and 3, right? This is kind of the cash flow is the only one that kind of has all 12 months. You got to kind of go through and put it in there. Again, if you're paying yourself $1,000 a month, you can drag it out. That's fine. Some of the other ones you got to kind of take a look at. Okay. Income statement, please note, it's all white. Okay. So there's nothing that you need to do to the income statement, but I want you to look at it. If you're minus, $35,000, that's probably not good. We might want to take a look at that, see if we can make, either cut some expenses or project a little better sales. And that'd be the same thing for years 2 and 3. Again, it's all white. Okay, nothing for you to do there. The balance sheet is going to be one place where it's all white. But there is going to be an exception here. In years 2 and 3, you're going to show some prepaid expenses here for some reason. Okay? And I'm going to ask you, force you, whatever, tell you that you're going to need to delete those numbers. Okay? Otherwise, you won't balance. The reason for that, it gets into the formula. Remember, I had you change that amortization period of startup costs from 3 year to 1 year. Okay, that's the reason for that. It's assuming still that it's over a 3-year period, and so it's putting some dollar figures in there that I don't want in there. I should just go in and change the formula. Sorry, I haven't. I probably should. So you'll delete those, and then you should balance. So if you get looking at your balance sheet and you're off by $500, and you come up here and you got $500 in prepaid expenses, guess what? That's what it is. So, okay. Questions about that? Okay. I'll quit there. You got between this week and next week too. It's your homework's going to get to be a little bit more, so you got a lot of work ahead of you. Plus, got to get these things finished up. So, let's get these done so we can put it to bed. What's going on? We got volleyball Friday night. Wednesday? Oh shoot! I got practice Wednesday. Okay, and Friday? Just Wednesday. Daggone it. Okay. Anything else? Football's away, right? Yeah, you guys are going to Eastern Oregon. Ooh. Have fun.